Understanding what a business does is essential for making informed decisions about its stock. Here are the key aspects to consider. Core business model and revenue streams, products and services. Know what the company sells and to whom. Assess whether the products or services have long-term demand. Revenue diversification. Identify if revenue comes from a single product or service or multiple sources. Companies with diversified revenue streams are typically less risky. Industry and market dynamics. Industry trends. Understand the overall industry's growth trajectory and competitive landscape. Market position. Evaluate if the company is a market leader, a challenger, or a niche player. Market leaders often have pricing power and economies of scale. Cyclicality. Some businesses are cyclical, for example, automotive or retail, while others are defensive, like utilities or healthcare. Cyclical stocks tend to perform better in economic expansions, but can be volatile. Competitive advantages, or moats. Unique selling proposition, or USP. Determine what sets the business apart, such as patents, brand strength, or cost advantages. Barriers to entry. Companies with strong barriers, like regulatory hurdles or high capital requirements, are less vulnerable to competition. Customer loyalty. Understand if the business has a loyal customer base, which supports stable revenue. Growth potential, market opportunities. Evaluate if the business operates in a growing market or has room to expand geographically or demographically. Innovation. Assess the company's ability to adapt to change and innovate to stay competitive. Scalability. Determine if the business can scale without significant cost increases. Risk factors, economic sensitivity. Identify whether the business is impacted by economic downturns, inflation, or changing regulations. Regulatory risks. Understand the regulatory environment surrounding the industry. Dependence on key markets. A company heavily reliant on one market or geography may be riskier. Disruption risks. Look out for disruptive competitors or technologies that could challenge the company's relevance. Financial health and fundamentals, revenue and profit margins. Analyze whether the business is profitable and how efficiently it converts sales into earnings. Debt levels. High debt can limit flexibility, while low debt is a sign of stability. Cash flow. Positive cash flow indicates the company can fund operations and growth without taking on additional debt. Earnings consistency. A history of stable or growing earnings reflects a reliable business model. Aligning your investments with your personal goals is, well, crucial. When we talk about growth versus value, it's important to know that growth companies reinvest their earnings to expand, while value companies prioritize dividends or stock buybacks. You should choose based on your risk tolerance and time horizon. For those of you who are income investors, it's essential to check if the company pays consistent dividends and has room to increase them. Lastly, you need to understand the stock's price volatility and how it aligns with your risk profile. Management and governance. Leadership. Research the track record of the CEO and management team. Transparency. Look for businesses that are open about their operations, financials, and strategy. Corporate governance. Strong governance minimizes risks of fraud and aligns management's interests with shareholders. Alignment with broader trends. Megatrends. Evaluate if the company benefits from trends like renewable energy, artificial intelligence, or e-commerce. ESG factors. Environmental, social, and governance considerations can impact long-term performance and appeal to certain investors. Emotional connection and conviction. Confidence in the business. Investing in a company you understand builds confidence, especially during market volatility. Understanding risk. Knowing the business reduces the risk of reacting emotionally to price swings. Investor mindset. Familiarity with the business fosters a long-term investment perspective rather than short-term speculation. By fully understanding what a business does and how it makes money, investors can evaluate its long-term viability, align it with their investment strategy, and manage risks more effectively. This knowledge provides a foundation for confident, rational decision-making,